Hi guys, Max here, and this is once again your daily market update for yesterday, this time the 5th of May, not April as I said last time. Now, of course, it was a crazy volatile day. We all know that, but it is getting just a little bit odd how volatile these swings are going and how we go from the best single day in over 2 years to the worst single day in over 2 years with no new news, no real developments regarding the markets or investments or anything like that, just investor sentiment changing. Now, what exactly happened for the day? Well, as you can see, it was just red across the board. Big tech got absolutely hammered. We see Apple and Microsoft down by around 5% each, along with Google and Facebook. Amazon, Tesla, and Nvidia down 7 or 8% each. Now, while big tech certainly did the worst, the rest of the markets didn't really fare much better either. Many financials like JP Morgan are down over 2%. Many consumer defensives, companies which are really secure and supposed to perform relatively well during a downturn like Costco, down over 4%. Healthcare was down, industrials was down, real estate was down, even energy was down slightly, despite the fact that energy prices, oil prices and things like that didn't actually decline for the day. Take an industry, take a sector, take a company at random, and the chances are that it fell, and not by a small amount. So how poor exactly was it? Well, in terms of the indices, it was one of the worst days in 2 years. The S&P 500 fell by 3.6%. The Nasdaq, the tech-heavy index from the US, fell by 5%. The Dow Jones fell by 3.1%. ARK, which is one of those investment ETFs that we like to talk about a lot because it pretty much encapsulates the bubble-heavy tech stocks, it was down 9% yesterday alone, making it its third worst performance in its entire history. Again, American equities just across the board did really, really poorly. But what about the rest of the world? Well, they didn't exactly put up stellar performances, but for the most part, it wasn't quite as bad as in the US. The FTSE 100 was mostly stagnant, the UK index, and it rose by 0.1%. In Europe, it was a little bit worse, with the STOXX 600 falling by 0.7%. And if we head over eastwards towards China, or the Hang Seng tech-heavy index over there, which is basically just the Nasdaq of China, well, it fell by 3.8%, so it was hardly any better over there. As for currencies, the thing which makes no sense to a lot of people was the fact that the dollar strengthened once again, this time by about 0.5%, again, against pretty much every other major currency. It rose by 0.4% against the euro, 0.2% against the yen, 0.5% against the yuan, and 0.4% against the pound as well, just showing huge amounts of strength in the face of diversity, probably because these other economies, like the British economy, which we will talk about in a bit in this video, they're going to suffer even more than the American economy will. Now, with regards to fixed income for bond prices and yields, I've been saying repeatedly over and over again that no, yields have not stopped rising. They are going to continue to rise and continue to soar. And that's what we saw yesterday with the US 10-year Treasury yield rising by 9 basis points and now sitting at 3.06%, well above that 3% mark that I have been saying is coming. Commodities then, what happened over there? Well, oil prices stayed very high and rose very slightly. WTI crude oil at the time of me making this video right now is sitting at $110 a barrel, and Brent crude always sits a little bit higher. It's sitting at $113 a barrel, which is why it was a little bit odd in some people's minds that energy stocks fell, because the underlying asset prices, the commodity prices that drive the profits of these companies actually rose slightly. But the monetary environment, the tightening that we're seeing from the Federal Reserve is just such a huge issue that no company, no industry, and no sector is entirely immune to it. Finally, then, we have crypto to look at, and what happened over there? Well, it was total capitulation, one of the worst days in months that we've seen for the crypto industry. As you can see, Bitcoin fell by 8% and it's now sitting around about $36,000. Ethereum fell by over 6% and is sitting below $2,800. The rest of the market as well fell across the board. Solana, DOT, ADA, Avalanche, BNB, Dogecoin, Shiba, any token you take at random and the chances are it fell. The little bits of green you see over here, like USDT and DAI, BUSD as well and UST, those are stable coins, so really we'd be surprised if we saw them dark red. Frankly, it would be quite nice if we could take these off of these heat maps. But in short, it was red across the board for crypto. It was a day of bleeding. It was really hard. And $400 million of Bitcoin longs were liquidated over the course of about 1 hour at the worst of this crash. Now, why did everything, all risk on assets, do so poorly then? Was there some special news that came out? Was there something that was said by Jerome Powell that wasn't said the day before? Because we literally saw one of the strongest days of performance for equities in months, actually in years, basically since the rebound from the COVID crash 2 years ago. And that instantly pivoted around to the worst day in 2 years since the COVID crash again. What actually happened? Well, here's the crazy thing. Absolutely nothing changed. Interest rates were hiked by 50 basis points and the markets rejoiced and rose 4%. Then, the day later, when they realized that interest rates were hiked by 50 basis points, they collapsed by 4%. There was no difference in what actually happened. We didn't hear anything new from Jerome Powell. Investors were just rereading the same articles, looking over the same sort of information again and again. And basically, investors just realized that there was no logical reason for the rally the day before yesterday. And so when markets opened back up, they crashed instantly. Ultimately, I can say this is a sign of stupid investors or algorithms being at work. But in reality, what this is the result of too much liquidity in the markets and no one knows where to put their money. This is what happens when you run quantitative easing for over a decade. This is what happens when you flood the markets with money, when you throw money out of helicopters into people's pockets and you give them nothing to spend it on except for gambling on their Robinhood trading accounts. If you're looking for a logical reason for some explicit trigger as to why yesterday was so red, I'm afraid there just isn't one. People are just finally recognizing that interest rate hikes are not good for valuations because they just mean it's so much more difficult to raise capital, more expensive to raise capital. So growth in the future will take hits and that needs to reflect a discounted price. And that's exactly what we saw happen yesterday. Stocks fell, crypto fell, risk on assets fell. Now, that was the case for the US, but elsewhere it is always a little bit different, isn't it? In the UK, for example, we also had our central bank, the Bank of England, come out and announce that they were going to be hiking interest rates again by 0.25%, which was actually a little bit of a dovish surprise. Personally, I was expecting to see a 0.5% rise again. That doesn't exactly mean that there aren't problems, though. News articles right now are flying around everywhere talking about basically just how screwed the UK, the British economy is, and for good reason. We have already started to see that our growth is slowing, our economy is slowing down. We are now being told that inflation is expected to rise above 10% before the end of 2022. A ridiculous level that will make it impossible practically because wages will not rise at that same level for our expenditure to remain the same, for our consumption to remain the same. The pound took a major hit yesterday and again it's sitting at $1.25 each. That's a really low level. And for exports, that's not exactly a bad thing, but for imports, that just means that things are going to be far more expensive day by day. And as a country that imports far more than we export, that's not good news for our economy either. The narrative that we're seeing right now is basically that our economy can't survive the quantitative tightening that we're about to enter. But if we don't tighten, if we don't raise interest rates, then we won't be able to survive the inflation that we're going to see either. Now, this is also happening exactly at the same time in Europe. It's happening in the US as well. The US was further along in this cycle, but it's all sort of been shifted and the UK and the EU is now on the back foot because of the energy price spike because we're so reliant on Russian natural gas. Just because Bloomberg aren't reporting on this problem in the EU, though, doesn't mean that it isn't there. It is just as prevalent over there across the little channel. It's just that, of course, we speak English. I speak English, so we focus on English-speaking countries most. We pay more attention to the UK and the US and Australia than we do countries like France. But the reality is, it's the same story across the Western world. The US will face this exact same crisis, but probably in about 6 months' time. You aren't as dependent on Russian gas, for example. You aren't actually dependent on Russian gas at all. You have your own domestic oil supply that is easily enough to fill your own needs. So these energy price spikes that we're seeing, you're not quite seeing yet, but don't get it twisted. Quantitative tightening will hammer the American economy too. It's just going to take longer to get to that point. And you're also in the exact same point regarding inflation. If you don't tighten, inflation is just going to continue to spiral out of control. And so it really does seem like there is no refuge here. Now, finally, before we sign off for today, there have been some updates regarding Elon Musk and the Twitter purchase agreement story. The first thing that I've seen reported on quite a bit is that the Federal Trade Commission, the FTC, is investigating this deal, and some outlets are making this out to be some kind of antitrust big crackdown on Elon. They're likening it to how the SEC had their little tuffle with Elon in the past as well, but this is nothing like this. This is perfectly standard. It's standard operating procedures. He has to wait at least 1 month before he can actually go through with this deal to allow the FTC adequate time to assess whether or not there are monopoly risks or security risks and things like that. What actually is big news, though, is the fact that over recent weeks, Elon has been hinting at the fact that he would be willing to allow certain private investors to either roll their shares into his deal, so to maintain their Twitter stake, or to actually buy into Twitter and to own a part of the company with Elon, again, while it is a private company, so not publicly traded. The reason I'm talking about this today then is because I've had quite a lot of people, because a lot of our viewers and some people I know personally own Twitter shares, and they're wondering if they will be given that opportunity to buy into this new private Twitter that will be run by Elon. And my basic position has been some people will be allowed to, but it's probably not you. You kind of have to be a big player here for that to be worth it. Now, why are we talking about this right now? Because we found out that, yeah, that is kind of the case. Certain investors, private investors, are going to be allowed to invest with Elon on this deal, but I can almost guarantee that no one watching this video is one of those allowed. Now, this screen that I'm showing you here is a list of those private investors who are going to be allowed to invest in Twitter with Elon. Now, there are a few important names here that are worth talking about. The first one is Capital Management with brackets A16Z here. Now, that is basically a man named Andreessen Horowitz, who is a big free speech advocate here on YouTube, on Twitter, and he is rolling in a $400 million stake into this deal with Elon. Next, we have Binance here, which isn't too surprising because Binance's CEO and founder, CZ, has been talking about joining this stake with Elon, about investing in it with Twitter. He is a huge advocate for decentralized finance in particular, but also for freedom of speech and for freedom from government. So this is kind of an ideological move, along with A16Z or Andreessen too. Now, the other interesting person to look at here is Lawrence J. Ellison Revocable Trust, who is basically Larry Ellison, who is a close billionaire personal friend of Elon. He had invested back in Tesla when it was worth a fraction of what it is today, and he owns $15 billion worth of Tesla stock. Almost a month ago now, I made a video talking about who might join Elon's bid, and I actually called out Larry Ellison because they've been good friends and they are very closely aligned in regards to freedom of speech and things like that. One person we are missing here that we may have expected to see is Peter Thiel, but he has apparently not joining this bid. Now, those three people that I just noted there, I personally don't think are in this for the money. I think they are ideological investors. They're there to help Elon take Twitter private, to help ease the financing costs on him, and to ensure that free speech is able to thrive under Twitter and that it sees strong, good management. There are, though, a bunch of firms here who are the polar opposite of that. The first is Sequoia Capital, which is one of the most popular, one of the most well-known venture capital trusts in the world. And as you can see, they are putting together $800 million for this deal. Now, I may be wrong, but I do not think that is an ideological bet. I think that's a bet on the company under Elon's tenure. We also have the exact same thing under Qatar Holding, who are putting forward $375 million. Again, I sort of doubt that the Qatari government, which is not exactly brilliant when it comes to freedom of rights or free speech or anything like that, I kind of doubt that they are in support of a freedom of speech Twitter. Finally, we had this interesting tweet from Al-Walid Talal, who you may remember from about a month ago because he runs the Kingdom of Saudi Arabia's basically private hedge fund, and he is the person who rejected Elon's offer about a month ago, and he's now turned around and said he's going to roll his $1.9 billion stake in Twitter into this private acquisition. Now again, the Kingdom of Saudi Arabia does not like free speech. They murdered a journalist in an embassy, a consulate, I can't remember which it was, but Khashoggi, they murdered him and cut him up because he supported free speech. So yeah, this is very, very clearly, in my opinion, a financial investment, not an investment in the betterment of humanity or anything like that. What this does tell me, though, is that these people are fully confident that Elon is basically going to improve Twitter as a business. They are fully expecting him to increase revenues, to actually grow the platform out, to probably get new users, to make it profitable, and to cut down the weak, to cut down a bunch of these basically overhyped tech workers who aren't worth their salt. Now, this isn't exactly a surprising turn of events. People, myself included, have been speculating about what will happen with Twitter for weeks now, but this is a piece of news nonetheless. That is it for the day. I want to thank you all for watching once again. Please, again, continue to give your insights into this new format. I did play around with the sound and the audio a little bit, and so hopefully it's a little bit better than it was yesterday. I am going to be trying out a new mic that is waiting. I'm waiting for it to come in the mail, so hopefully that'll make some improvements too. Please, as always, leave your criticism, your critiques, or your support, anything like that in the comments down below. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm and help the channel out. Also, make sure to check out our Patreon and join our exclusive community of investors where we discuss everything about the markets and you get exclusive private access into my portfolio with buy and sell alerts for all my own investments. There's a link in the description to Masterworks which can help you protect your portfolio against market crashes through fractional shares of art from world famous artists like Banksy. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets as bad as they are. Finally, there's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. It's literally free money, and you can earn interest on your crypto there too. Thank you all for watching. Stay stoic. Until next time.